Welcome back. In this video, we're going to talk about analyzing the project, which is part of fundamentals of capital budgeting. Remember that this video is the third one, so we've had videos about forecasting earnings. We've had a video about determining free cash flow and NPV. This is the third one, and the last video is about a summary concerning fundamentals of capital budgeting. Let's have a look at break-even analysis. The definition of break-even analysis is that we need to bring the NPV of the investment to equal zero. And we can do that by using the IRR. And IRR stands for internal rate of return. Let's have a closer look at IRR. The internal rate of return is a way of expressing the value of a project in a percentage instead of in a euro amount. So in the language of finance, the internal rate of return is the discount rate or the firm's cost of capital that makes the present value of the project's cash flow equal to the initial investment. So this is what we call break-even analysis. So we need to bring the net present value of the project to equal zero. Put differently, the internal rate of return is nothing more than an estimate of the project's rate of return. So the IRR can be seen as the total return of the project. And the total return of the project, looking at spacecraft, is 24.1%. So it means that the 24.1% gives, for spacecraft, an NPV of zero. Now, let's have a look at the decision rules for IRR. First of all, you may wonder, okay, but how did we calculate the IRR? The IRR is calculated using Excel. It's a rather difficult metric. But with an Excel spreadsheet, you can actually iterate the information and you can find the rate of return that sets the project value to zero in a simple function. So in other words, what we normally use to calculate IRR is a Excel spreadsheet. Let's assume that we've used the spreadsheet and we've calculated the IRR. As we can see, the IRR of spacecraft is 24.1%. So this is the total return of the project. Okay, so how does the decision rules for IRR actually work? If the IRR of a project, in this case 24.1%, is greater than or equal to the project's cost of capital, which is 12%, then you need to accept the project. However, if the IRR, 24.1%, is less than a project's cost of capital, in this case it's not, but let's assume it is, then you need to reject the project. The rationale is that you never want to take on a project for your company that returns less money than you can pay to borrow money, that is the company's cost of capital. In sum, and let's put it simply, the total return of the project is 24.1%. Let's assume that we're facing capital providers who demand 10%. So in other words, we make 24%, that's the maximum return that a project makes. We need to pay 10, so we would have at the end of the day a positive NPV. Because we generate 24%, we need to pay 10%, so basically we're both happy because we make a positive NPV, we add value to the firm. Let's assume that we're having a 24% IRR, but we're facing capital providers who need, let's say, 50%. So that means that we generate 24%, we need to pay 50%, which means that we run into a negative NPV. Our project can't carry the 50% for the simple reason that we only make 24%. So we would have a negative NPV and we would both be unhappy. We are now going to have a look at sensitivity analysis. And the sensitivity analysis shows you how the net present value varies with a change in one of the assumptions. For example, changes in units sold, or changes in the sale price, or changes in the net working capital investment, holding the other assumptions constant. Now, in the next slide, I'm going to show you how the sensitivity analysis works for our spacecraft project. In this table, I have presented the sensitivity analysis concerning some of the items, and these are the best and worst case scenarios for space agency, but of course for the underlying spacecraft project. You recognize the initial assumptions. For example, in the base case, we have assumed that we're going to sell 100,000 units. The sale price was 260. The cost of goods sold was 110. We had some working capital investment and cannibalization, and we have used a cost of capital of 12%. Now, in the worst case, we have assumed that some of the initial assumptions are getting worse. For example, 70,000 units sold, cannibalization is going to be worse, 40%, cost of capital 50%. And in the best case scenario, I actually made the initial assumptions better. For example, we're going to sell 130,000 units. The sale price is going to be a little bit higher at 280, cannibalization less, 10%, and the cost of capital at 10%. This is how we are going to present the best and worst case assumptions. What you can see here are all the inputs. We have units sold, sale price, cost of goods sold, net working capital, cannibalization, and cost of capital. And here we have the project's NPV. So if we look at our base case, you can see that 100 units sold, 260, 110, working capital 2.1, 25% cannibalization, and cost of capital 12%. Gives us an NPV of about 5 million. This was considered our base case scenario. Now, what you can see is that if you're going to change your assumptions, for example, you're going to sell less units, or you're going to reduce your sale price, or your cost of goods sold per unit is going to be higher, or you're going to increase your working capital, you're going to increase your cannibalization and cost of capital, you can see that the NPV is getting worse, right? Because this was the original NPV, and everything on the left-hand side gives you a lower NPV. Now, vice versa, if you're going to improve your assumptions, you're going to get a higher NPV. Okay? Now, this is very nice because this actually shows you the impact of changes in your underlying assumptions on the NPV. And of course, at the end of the day, you need to make a decision what would be the most likely scenario before you're going to invest money in the project. And here you can see why we choose 260 units for our sale price. Because this table shows you different kinds of pricing strategies for a spacecraft. The current strategy was that we're going to sell our product for 260, and we expect to sell 100,000, and the NPV is about 5 million. Now, if we would reduce the price to 245, we sell more, but the NPV would be less. If we would have increased the price, we would sell at a price of 275. We would, however, sell less, and also the NPV would be less. So in other words, it makes the most sense to sell the product for 260 because that would be giving us the highest NPV. Let's look at the situation in which we simultaneously going to change the price per unit and annual units sold. So in this graph, you can see the NPVs. And all the points on the line gives you an NPV of 5 million. As a matter of fact, all combinations on the line, so everything on the blue line, is going to give you an NPV of 5 million. Remember that we have price per unit over here and we have annual units sold over here. So, for example, if we sell 100,000 units at a price of 260, we would get a NPV of 5 million. We would get an equivalent 5 million if we would, for example, sell 70,000 units at a price of 320. Or we would get an equivalent NPV of 5 million if we would sell 150,000 units at a price of about 220. Okay, so in other words, this gives you all price quantity combinations which will generate the same NPV of 5 million. We have come to the end of this video. We've discussed the project analysis, and the next video would give you a summary of fundamentals of capital budgeting. So my suggestion is to please open the next video. Thank you.